Rough week at CarMax. The Goochland-based company is now confirming hundreds of layoffs.
In fact, about 350 workers were let go nationwide, including about 2 dozen in this area.
CarMax is cutting hundreds more jobs, including many here in Richmond. In a story first reported by our news partners at Richmond BizSense, the Goochland-based used car company announced today it's laying off 230 more corporate office workers.
CarMax is cutting prices. $150 million in layoffs are coming. And somehow, nobody is buying. I am standing in the middle of one of the largest used car lots in America right now. Cars are parked in the driving aisles. Cars are stacked in the overflow. There is literally nowhere left to put them. This is the biggest used car dealer in the United States. They move thousands of cars every single week. Or they used to. Because right now, those cars are just sitting here, rotting. And the company that owns them just lost half its value, fired its CEO, and announced $150 million in cuts, which means real people losing real jobs. Here is the part that nobody is saying out loud. They already dropped the prices, and buyers still said no. So the question you need to ask yourself right now is this. If the largest used car dealer in America cannot sell cars even after slashing prices, what does that tell you about where this entire market is actually headed? CarMax is not just struggling. CarMax is drowning in metal. Walk through one of their lots right now, and you will see something that should not be possible for a company this size. Cars parked in the driving aisles. Cars sitting in overflow areas that were never meant to hold inventory. Vehicles lined up so tight that the lot itself barely functions anymore. This is not a small regional dealer having a rough quarter. This is the largest used car operation in the United States, running out of physical space to store the cars it cannot sell. How does this happen? It starts with timing. When the market was hot, CarMax did what every dealer does. They bought aggressively. They stocked up. They paid high prices to acquire inventory because buyers were everywhere and the money was flowing. That was the playbook, and for a while it worked perfectly. Then the buyers disappeared. Not slowly, not gradually, in a way that gave anyone time to adjust. The demand just stopped showing up the way it used to. And CarMax was left holding thousands of vehicles purchased at peak prices in a market that had already moved in the opposite direction. Here is where the math turns brutal. Every single day, a car sits on that lot. It loses value. Depreciation does not pause because sales are slow. It does not care that CarMax paid top dollar to acquire the vehicle. The clock is running from the moment the car arrives, and the longer it sits, the wider the gap grows between what they paid and what they can realistically sell it for today. And the inventory keeps coming. Because at a company this size, the buying pipeline does not just switch off overnight. Contracts are in place. Auctions are attended. Vehicles are acquired on a schedule built around a demand level that no longer exists. So the lot fills up further. The aisles get tighter. The overflow areas reach capacity. And somewhere in a corporate office, the numbers on a spreadsheet get harder and harder to explain to shareholders. This is what an inventory crisis actually looks like from the inside. Not a headline, not a quarterly earnings footnote. Real cars, sitting on real asphalt, bleeding value every single day, while the company that owns them scrambles for a solution. The problem is that too much inventory is just the symptom. The disease is something deeper and far more expensive to fix. Because CarMax did not end up here by accident. They ended up here because the consumer, who was supposed to show up and buy all of these cars, simply stopped coming. And that is where this story gets a lot more complicated. Sales are down 10% year over year. And here's the part that should stop you cold. They already cut the prices. This is not a situation where CarMax stubbornly held the line on inflated numbers while buyers walked away. They saw the problem. They responded. They dropped prices across the board and waited for the buyers to come back. And the buyers looked at those lower prices and still said no. That tells you something critical about what is actually happening here. This is not a pricing problem. This is a demand problem. And those two things require completely different solutions. Here is how the trap works in real numbers. Take a 2022 Jeep sitting on the lot at $30,000, no buyers. Drop it to $27,000, still no buyers. Push it down to $25,000 and maybe, you find someone willing to sign. So, you sell it. Problem solved, right? Wrong. Because now you have to go replace that Jeep. And when CarMax goes back to the auction to restock, they are not buying in a vacuum. Carvana is at that same auction. Other dealers are at that same auction. And those competitors are willing to pay $26,000 or $27,000 for the exact same vehicle because at face value their numbers still look strong enough to justify it. So CarMax sells at $25,000 and restocks at $26,000. Do that math across thousands of vehicles, and you are not running a used car business anymore. You are running a very expensive charity. This is the inventory replacement conundrum, and it is squeezing CarMax from both directions simultaneously. Lower prices to move the metal sitting on the lot, but pay market rate to refill the lot because the competition is not lowering what they will pay to acquire cars. There is no version of that equation where the numbers work cleanly. And the deeper truth underneath all of this is the one nobody at CarMax wants to say directly. If dropping prices is not bringing buyers back, it means the prices were not actually the barrier. The buyers are not sitting at home waiting for a better deal. They are sitting at home because they cannot qualify for the loan, cannot afford the insurance, cannot absorb another monthly payment on top of everything else already pressing down on their budget. The price was never the real problem. The consumer was already broken before CarMax dropped a single dollar off a single sticker. And once you understand that, the 10% sales decline stops looking like a speed bump. It starts looking exactly like what it is. The beginning of something much bigger and much harder to reverse. When a company the size of CarMax fires its CEO, that is not a routine leadership change. That is a signal. That is the board sitting in a room, looking at the numbers, and deciding that the person steering the ship does not have what it takes to navigate what is coming. It is an admission that something is fundamentally broken and that fixing it requires a different kind of thinking at the very top. So who did they bring in to lead the largest used car dealer in America through the worst market conditions it has faced in years? The former CEO of Holiday Inn Express. Let that land for a second. Not an automotive veteran, not someone who spent decades understanding inventory cycles, vehicle depreciation, subprime lending, or the mechanics of moving metal off a lot at scale. A hospitality executive. Someone whose entire professional background was built around hotel rooms, loyalty programs, and guest experience scores. The stock market made its opinion very clear the moment the announcement dropped. Shares sold off by 10% in a single session. Investors did not need time to think about it. The reaction was immediate and brutal because what the market heard was not a bold visionary move. What the market heard was a company that has run out of conventional answers. And here is the thing. The board at CarMax is not stupid. These are not people making random decisions under pressure. The choice to bring in someone from outside the automotive world is deliberate. It is a calculated bet that CarMax's survival does not depend on selling cars better. It depends on becoming a technology company that happens to sell cars. The pivot they are chasing is digital. Online transactions, streamlined financing, a buying experience that looks less like a dealership, and more like an e-commerce platform. That is the vision. That is what the Holiday Inn executive is being brought in to build. Someone who understands customer experience at scale, digital transformation, and brand repositioning in a crowded market. The problem is that vision does not solve what is happening on the lot right now. You cannot digitize your way out of 10% declining sales when the consumer is already tapped out. You cannot build an app that makes someone qualify for a loan they cannot afford. The long-term strategic bet might make sense on a whiteboard in a boardroom, but the cars are still sitting in the aisles today. The inventory is still bleeding value today. The layoffs are still coming today. Bringing in a hotel executive to fix a car crisis might be exactly the right long-term move, or it might be the most expensive experiment in automotive retail history. Right now, nobody knows which one it is, and that uncertainty is exactly what is making investors so nervous. Here is the question that is eating CarMax's board alive right now. How is Carvana winning while we are drowning? Same market, same stretched consumer, same rising delinquencies, same impossible financing environment squeezing buyers from every direction. And yet while CarMax stock has been cut in half, Carvana's numbers have been trending in the opposite direction. To any investor sitting across both of those charts, that gap looks insane. And it is driving the kind of boardroom panic that gets CEOs fired and hotel executives hired. But here is what that comparison is actually hiding. Carvana is not primarily a car company. Never really was. The cars are the front door. The product being sold out the back is something else entirely. Carvana's real business is loans. Writing them, packaging them, and selling them off for profit before anyone has to find out whether the borrower can actually pay. Here is how the machine works. Carvana writes loans for buyers who, in a functioning lending environment, would never get approved. They package those loans together and sell them to outside companies at elevated prices that no rational third-party investor would actually pay. And here is where it gets uncomfortable. The companies buying those loans at inflated prices are owned by the Garcia family, the same family that controls Carvana. So Carvana sells overpriced loans to companies that are essentially themselves, books the profit, reports strong earnings, and the stock price goes up. Then the Garcia family sells stock at that elevated price, takes that money, buys more loans, stock goes up again, sells more stock. The circle keeps spinning as long as nobody looks too closely at what is actually inside those loan packages, or questions why any company would pay a premium for assets that are quietly rotting underneath the surface. A prominent short-selling firm looked closely. Their report accused Carvana of misleading shareholders, inflating earnings through related party transactions, and building what appears to be a financial house of cards, held together by the same family's money cycling through different corporate shells. The uncomfortable reality is that Carvana's performance and CarMax's performance might not be opposites at all. They might be the same story told two different ways. One company avoided the worst subprime exposure and is now visibly suffering for it. The other papered over the damage with financial engineering and is still waiting for the moment the music stops. Because the music always stops. And when it does, the lot full of unsold cars at CarMax is going to look like the least of the industry's problems compared to what unravels on the other side of those loan packages nobody wanted to examine too carefully. $150 million. That is the number CarMax put on the table when they announced their cost-cutting plan. And if you hear that figure and think it sounds like a corporate accounting exercise, a line-item shuffle that happens somewhere far away from real people, you are thinking about it wrong. $150 million in cuts means bodies. It means people who showed up to work every single day, clocked in, moved cars, processed paperwork, ran financing desks, managed lots, answered phones, and kept this machine running, are now looking at termination notices and wondering what comes next. Layoffs, restructuring, store closures. That is what $150 million in cuts translates to when you strip away the corporate language and look at what it actually means on the ground. And this is not happening in isolation. The auto industry around CarMax is fracturing at exactly the same time. Stellantis, the parent company behind Jeep, Dodge, and Ram, has been taking body blow after body blow. Plants shutting down, production lines going quiet. Workers sent home with no clear timeline for when or whether things come back. The manufacturers are bleeding, the dealers are bleeding, and now the used car giants are bleeding too. Every layer of the automotive food chain is under pressure simultaneously, and the people absorbing the most pain are always the ones at the bottom of the org chart, never the ones who designed the strategy that created the problem. Here is what makes this particularly damaging beyond the individual job losses. CarMax stores are not tucked away in industrial parks where their closure goes unnoticed. They sit in retail corridors, surrounded by restaurants, service businesses, and shops that depend on foot traffic and the economic activity a major employer generates. When a CarMax closes, the ripple moves outward through the surrounding businesses, the tax base, the local employment numbers. One store closure is a neighborhood economic event, not just a corporate restructuring line item. And then the feedback loop tightens further. Laid-off CarMax employees become consumers with less money. Consumers with less money buy fewer cars. Fewer car sales means less need for staff at the dealerships still operating, which means more cuts, which means more consumers with less money. The cycle feeds itself, and each rotation of it pulls more people into the current. This is the part of the story that never makes it into the earnings call. The human infrastructure behind these numbers is crumbling quietly, while the headlines focus on stock prices and CEO appointments. $150 million in cuts sounds like a business decision. For the people holding those termination notices right now, it feels like something else entirely. It feels like the ground disappearing underneath them without warning. Everything we have covered so far, the overflowing lots, the falling prices, the fired CEO, the layoffs, all of it traces back to one single root cause. The American consumer is broken. Not bending, not stretching. Broken. This is not a feeling or an opinion. This is showing up in the data from every direction at once. Credit availability is tightening as lenders pull back on approvals, recognizing that the borrowers they were saying yes to 18 months ago are now the ones missing payments and losing cars to repo trucks. Delinquency rates are climbing. The loans that looked manageable when they were written are revealing themselves for what they actually were. Bets placed on income stability and financial breathing room that millions of Americans simply do not have anymore. And here is what makes this particularly hard to fix. The consumer is not saying no to cars because of price alone. They are saying no because they are exhausted, maxed out credit cards, rent that has not come back down, grocery bills that never stopped climbing, insurance costs that jumped and stayed jumped. When every single monthly obligation is already pressing against the ceiling, there is no room left for a car payment regardless of how many times CarMax drops the sticker price. You cannot discount your way into a wallet that is already empty. This is the buyer that fueled the 2021 and 2022 car market. The subprime consumer who got approved fast, signed long loan terms, drove off the lot feeling like they had won something. Those same buyers are now the ones showing up in the delinquency numbers, the ones whose cars are getting pulled before sunrise. The party that the whole industry threw during those peak years is now presenting its bill, and the consumer is the one being handed the check. CarMax, to their credit, pulled back from the worst of the subprime exposure. They made a deliberate decision not to chase the bottom of the credit pool the way some competitors did. That discipline is the reason they are still standing while others are quietly unwinding. But that same discipline is now a ceiling on their recovery. The buyers they are willing to approve are fewer in number. The buyers who could be approved are fewer in income. the overlap between those two groups is shrinking by the month. The one flicker of short-term light is tax season. Refund checks hitting bank accounts, $3,000 and $4,000, suddenly available for down payments on cars that would otherwise be out of reach. For a few weeks every spring, used car dealers see a genuine pulse in traffic and sales. It is real. It moves numbers. But it is a season, not a solution. And when it ends, the same broken consumer is still standing there on the other side of it. The trajectory here is not a mystery. The numbers are moving in one direction, and that direction is not better. Inventory stays elevated. Demand stays weak. The financial pressure on every household in America is not suddenly going to lift because CarMax needs it to. The reset that is coming for the used car market is not a question of if. It is a question of how deep and how long. And CarMax's biggest challenge through all of this is one that has nothing to do with their CEO or their strategy or their brand. It is scale. A small dealer like a local independent lot can move fast. If a car sits for 2 weeks, drop it $500. Sit another 2 weeks, drop it again. Find the number, sell the car, move on. That kind of surgical price discovery is impossible at CarMax's size. Every percentage point they shave off their pricing across thousands of vehicles is not a rounding error. It is millions of dollars evaporating from the balance sheet in a single decision. So they move slowly and carefully while the inventory keeps bleeding value underneath them. For anyone who bought a used car between 2021 and 2023 at peak market prices, what is coming next is not good news. Those vehicles were purchased at numbers that the market has already walked away from. As dealer prices continue dropping to find real buyers, the gap between what those owners owe on their loans and what their car is actually worth in today's market is going to widen. Negative equity. Underwater. Whatever you want to call it, it means being trapped in a vehicle you cannot afford to sell without bringing cash to the table just to break even. But here's the other side of that same story. For the patient buyer, for the person who waited, for the one who did not panic purchase at the peak, this market is slowly becoming the most favorable buying environment in years. Cash buyers especially are walking into a negotiation with leverage they have not had since before the pandemic turned the entire used car market upside down. The warning for anyone considering financing a used car right now is simple. The market is correcting, but it has not finished correcting. Prices are falling, but they are not done falling. The buyer who moves too early locks in a number that the market will beat in 3 months. Patience right now is not hesitation. It is strategy. The lot is full. The prices are dropping. The company is cutting costs and changing leadership and hoping that something shifts before the pressure becomes unbearable. What happens next depends entirely on whether the American consumer finds any financial breathing room. And right now, there is very little evidence that they will anytime soon. Come back to that image one more time. A CarMax lot so full of cars that vehicles are parked in the driving aisles. The largest used car dealer in America physically running out of room to store the inventory it cannot sell. That image is not an accident, and it is not a temporary inconvenience that a new CEO and a price cut will quietly resolve. That image is a symptom of something much larger, breaking down across the entire used car market all at once. Here is the pattern underneath everything we covered today. Prices got too high, loans got too loose, consumers got too stretched, and the industry that built its recent profits on all three of those conditions is now watching all three unwind simultaneously. CarMax is the most visible casualty right now because of its size, but the same pressure is sitting on every major used car operation in this country. The name on the sign changes. The problem underneath is identical. The people who understand what is actually happening right now are the ones who will come out of this ahead. The patient buyer who recognizes that prices have further to fall. The consumer who refuses to be rushed into a financing decision by a salesperson working against a quota. The person who walks onto a lot carrying data instead of emotion. Those are the people this market is about to reward. And that is exactly why, before you step foot on any lot, you need to download the free ebook, Avoid These 17 Cars in 2026. Depreciation charts showing exactly which vehicles hold value and which ones crater the moment you drive off the lot. Reliability data pulled from real owners. The specific models that mechanics see on their lifts week after week. The cars that insurance companies already know will cost you before you find out yourself. The link is in the description. Download it, read it, then go negotiate. The lot is full. The prices are falling. The only question left is whether you are the one taking advantage of this moment or the one still waiting while someone else does.